Hi everybody, welcome to Crafting a Business. We are here with Steven Bandeski. Hopefully I've said that correctly. So funny story, me and Steve have not met IRL before today. IRL, even before about like 2 minutes ago. All of our interactions has been online, over Zoom, via email. There's a voice message in there. Anyway, yeah, I'll talk about the voice message later. But this is the first time we've met in person, but it feels like, you know.
Besties from a long time, right? It's all the whole virtual environment has changed. Yeah, I mean, since COVID, the whole virtual, that's the norm these days, right? So when you see someone through a screen, it's almost like seeing them face to face. So that's why now seeing you in real life, I don't feel awkward. I feel like I know you because I do know you, right? And that's how the majority of business is conducted today. But no, thanks for having me.
Yeah,
thanks, I'm excited to be. It's great.
Well, I mean, there is going to be an element of seriousness in this podcast.
Okay,
Let's just get that out.
Let's get the seriousness out of the way first.
But most of it's going to be laughing, let's be real.
Good.
Let's be real. I wanted to get you on because I want to know your story. Obviously, I know bits of the story and the banking background and all of that and how you became a bit of how you became a broker now. But I want to know everything. So take me back to the very, not the very beginning when you were a tiny child and all that.
Yeah.
Back to your start of the career. What made you become a broker and how did you get here?
Yeah, I mean, this wasn't the path, eh? This really wasn't the path. If we're going to go all the way back to when I started the banking career, I entered the bank in the call center environment. In the call center environment, doing consumer lending, personal loans and credit cards is where I started back in 2003. So a little over 20 years ago, right? But that's wasn't the goal. I entered the banking environment not to stay in that role in the call center environment. I wanted to move to the IT department because I studied IT, believe it or not. Yeah, so I finished school, I studied IT, I did this diploma of network engineering. But sadly, when I finished my studies, there was a bit of a crash in the IT industry and I had to work. So I went into banking, thinking it would be short term. It wasn't short term, 21 years with the Westpac Group, St. George for 16 years and then Rams for 5 after that. And all of that time in lending in some way, shape or form, whether it's on the tools or coaching or whatever it might be. I started in the call center, lasted there for 3 or 4 years in the call center and then moved my way into credit assessment. So I spent 12 months doing consumer lending. And then I jumped straight into resi lending. And I loved resi lending from the get-go.
Okay, so I had to learn this term. Resi is residential.
Yes, resi is residential lending.
Okay. What other types of lending is there?
Well, there's commercial lending for commercial properties. There's, personal finance for any types of personal lending, whether it be car, holidays, personal loans, and your credit cards are your credit cards, right? Where my passion lies is anything to do with property. For some reason, I like property, whether it's residential lending or commercial lending for property. That's where my passion lies. And maybe that's where a lot of Aussies, their passion does lie in resi or in property. Aussies have this infatuation around owning property, owning real estate. Maybe because they can build wealth through real estate, and a lot of the times you can, but there is this infatuation around owning your own property, paying it off, starting a portfolio, whether it be for investment or cash flow, whatever it might be. But there is this kind of vibe in Australia, which I don't think exists in other parts of the world. And that's really resonated with me from a really young age, doing residential lending. So I did resi lending on the tools, if you'd like to call us tools, for the best part of 10 years, doing all types of sales type roles, credit analytical style roles. I was actually on the other side of the fence where brokers actually lodge applications. We were assessing and approving those applications and adhering to banks' policies and risk appetites and things like that. I kind of went off the tools a little bit in a more senior style role where I was doing some capability style work, training new starters how to assess a home loan application, how to be risk adverse and adhere to the bank's appetite. And then I did something similar at Rams, and then my final role at Rams had a whole bunch of different key pillars, which I'll leave that for the corporate space, right? But I learnt a lot in my career. I learnt a lot, specialising in all types of self-employed applications, the complex of complex, we used to get, self-managed super fund applications. And it really opened my eyes to different investment strategies and vehicles that people are using to build wealth through property. And I love that, right? Because every stage of my career, I was learning something new. Everyone comes in, starts, and they give them the easy files to work on. Right? This is what you're going to do, right? Very easy, pay-as-you-go applicants, one property, and then it gets harder and harder as you go on. But that's what kept me there for so long, because it wasn't boring. And each application, there was something new to learn with each individual, because whilst for the most part, the strategy might be the same around, I want to grow an investment portfolio. Sure, I mean, but how do we get there? How do we get there? And each individual's journey is a little different. And that part I loved, right? Because some people might go like that and some people might go a little bit like that. And so I learned a lot from that. That was my banking career. Always wanted to be a broker. Been wanting to go out as a broker for probably the last decade. But as you know, life kind of throws different challenges at you. Not so much challenges, but life happens, right? Life happens, different priorities at different times. So I finished up at the bank 2024, jumped into my own business from there. I said, it's got to be now. It's got to be now. What I've learned, I can't do something else. It would be criminal to do something else and not share what's upstairs in my head, yeah? I need to share that with the world and with the public and help people on their journey. Because whilst lending might be simple to me, it's not. And I don't expect it to be for the average Aussie. It is not simple. The complexities are out there and they're only getting even more complex. Yeah, let's just touch on the budget, right? We'll get back to the budget. But the budget has thrown a massive spanner in the works for investors. So much so that even though legislation is not coming to pass yet, the banks are already starting to adopt new policies around the announcement of the budget, which is well ahead of time. That alone is a massive complexity that we as brokers, as individuals, all need to now deal with. On top of all the other complexities that there are out there already. So my job is to make it clear, right? To explain, to educate. I won't say advise, but it's to educate, yeah? Because one can only make a good, sound decision if they've got the right knowledge base. And the knowledge base starts with us. You can't expect people to know the difference between a fixed loan and a variable loan. In the simplest of form, fixed and variable. A lot of people say, what's the difference? Yeah, but that's where the educational piece comes in, and you have to educate. So I've transitioned to be a broker, to be part of that. And I know that there's a lot of savvy investors out there that know the jargon, they know, but for the majority of Aussies, they don't know. Or they need a little bit of guidance. And this is where we should be playing a bigger part as brokers in guiding them.
I really love that you kind of talked about being almost like part translator, part educator, part, on the tools, knowing what's happening out there. Like, I don't know the first thing about the budget. I probably should. I hear things, but I don't know in any depth, right? What are the things that people can do to kind of stay abreast of it, right? But not to the same level that you need to know. You know what I mean?
Yeah.
Like, the kind of savviness and, tell me about that.
Again, it depends on their individual journey, but if they're on the fence, if they've been on the fence of should I invest, should I not invest, I think you need to make a decision, and it needs to be an educated decision. If I do this now, what can I invest in? Because the dollar figure is going to be very different. There's talks of when they strip out negative gearing for the individuals, there's talks of that's going to shave 30% off your borrowing capacity. So if your borrowing capacity was $1 million and you shave 30% off that, 300 grand is gone. The type of property that you were looking to buy yesterday is not the type of property that you're looking to buy today. That'll change your whole investment strategy, right? Whether it's a property here in Sydney or interstate, that dollar value alone will change things. So the only thing I say is, if you're on the fence, don't be on the fence. Make a decision. You're either going forward with this now or you're not. And for those that have already gone forward, pre the 12th of May, good on them because no change to them. But if you are going forward, you really need to understand what you're missing out on. And it might not be as much as you think. And I say that because the lower purchase price properties obviously have a lower loan amount. And therefore your out of pocket may not be as great. And if your out of pocket is not as great, your negative gearing benefit is also not huge either. So whilst previously they may have received $4,000 or $5,000 in a tax return, they may not get that now. But can you absorb that? And I'm just using that as a hypothetical example, right? If you can absorb that $4,000 or $5,000, then it still might make sense to invest because of the capital growth. So the tax deduction is just one component of the strategy, but it does need to be looked at, because if that was a key component of your strategy to reduce your taxable income, well, you might not have that moving forward, depending on whether the bill gets passed or not. So all I say is review the strategy. And if you have a financial planner, talk to the financial planner. If you don't, then talk to your broker, talk to whoever, your accountant, talk to whoever you need to satisfy yourself around your strategy. Because a lot of people won't have financial planners. They will kind of go it alone. They will kind of go it alone, and they rely on professionals like us, not for advice, for guidance, because I can guide you on what lending structures are available, and then it would be up to your accountant to give you advice on whether that lending structure is most suitable to you. But ultimately, it's your decision around your strategy, unless you've got a financial planner behind you.
I want to talk a little bit about your current clients. Are there any particular themes that you're seeing? Like, are there any particular things that when someone comes to you, do you know, like, what's going to be stressing them out, what their questions are about, you know? Because for me, I don't know anything about this space, and like borrowing and all the terms that use resi and I don't know anything, right? So what are the themes that you're seeing when clients first come to you?
Yeah, good question. Good question. The younger generation are very high level. And I expect that, right? Steve, we want to buy an investment property, but we really have no idea where to go and how to start. And a lot of them are looking to invest while they're still living at home with mum and dad to kind of get ahead. And they may become what they call rent investors. They may rent and have an investment property. So rent where you want to live and invest where you can afford. You know, that's the whole rent investor strategy. And for the younger generation, there's a lot of misconception around you need to have an X amount deposit and you need to rely on government grants. And all that is true if you're purchasing an owner-occupied property without any external support. And I'll talk about the external support. What I mean by external support is the few clients that I've had of late, young generation, I've been able to help them with mum and dad's support.
As a guarantor?
Yes.
See, I know a little bit. Okay,
yes,
okay.
As a guarantor. So people think, oh, mum and dad support, but they don't have cash that they can inject. They don't need cash to inject. They're not a borrower on the loans. They don't need to service the loan. They're not responsible for serviceability, i.e. making repayments on the loan. If they have a property with a bit of equity in the property, then we may be able to use their property as equity to purchase either a property to live in for the kids or an investment property. And of late, in the last 3 months, I've helped 3 separate couples get into an investment property with pretty much zero deposit. Yeah, so they've borrowed the whole amount, including cost. It's not just, oh, okay, I need 5%. No, you need zero. So long as you have a good, stable job, we'll calculate your borrowing capacity. If mum and dad have some equity that they can chuck in, we will borrow the lot, 100% plus cost. And that's called a limited guarantee. Yeah? So mum and dad can help that way. And it's not a forever thing. And to mum and dads, I say to the mum and dads, just because you're going on as guarantor now, it's not forever. In 2 or 3 years' time, as the kids' property goes up in value and it can hold their loan on its own, at 80%, then we will put a request in to release your property as guarantor. So it's not a permanent fixture. When you explain to mum and dad a couple of key things, A, it's not a permanent fixture. In a few years' time, we're going to look to release you. And B, it's a limited guarantee, meaning we're not taking your whole $2 million property as equity. We're only going to take a small portion as equity, for example, $200,000. That makes mum and dad feel more comfortable about the transaction. And it kind of automatically, they have an aha moment. Aha, I didn't know it worked that way. I thought you were taking my whole property. No. So again, it comes back to the educational piece. And we're not just educating the borrowers now. We're educating the guarantors, mum and dad, making them feel comfortable, knowing that this is not a 30-year thing. 2 to 5 years, whatever it might be, as soon as the kids' property goes up, we put a release in, go on with your life.
Do you see that as having not multiple clients, but like in marketing, we talk about personas, right? Different people that you have a different message for a different particular person. Yeah. Do you find that your delivery and education and translating and all the things that we talked about before is different to the person that wants to buy the property, the young person, versus the parents? And how do you change your messaging? Yeah,
look, and often parents are a little bit more versed in lending and how it works, and sometimes they haven't had lending for a little while and they need a bit of a refresher, but it quickly comes back to them. Oh, yes, I understand. It quickly comes back to them. And so, yes, we just pivot and change as we need to, and I kind of read people's body language, right? So if I see like this kind of blank face, then I'll peel it back a bit. And say, okay, let's peel it back a bit. I'll give them a live example, and I often use their example. Okay, this is the value of your property. This is your mortgage at the moment. This is the equity that you have. That's great. We only need X amount of equity for the kids, so we're only tying up this much. That's all. That's all we're doing. And when you actually put pen to paper and you show them the numbers, they really do have that aha moment. I get it. Okay, I'm comfortable with that. Yeah, if it's only for a few years. And then a little light bulb often goes with them, and this has happened a couple of times, where they go, so in a few years' time, we'll release from this child's property, and then perhaps we can do the same for our younger child. Absolutely, you can do the same for the younger child. So it avoids having to think about a cash injection. As great as parents are, they want to help the kids as much as possible, but sometimes a cash injection is just not possible, not in that point in time. But this way it avoids a cash injection. There's no need for it. It's an equity injection, and we get the kids on their merry way. Start that wealth journey. Start that compound growth. Pay down your loan a little bit. Compound growth goes up. You build a bit of equity. Release mum and dad. If you build enough equity, the kids then go again on their own. You see how that goes? It's a great model. I've been doing it for 20 years. And the most common question I get from parents, from guarantors, is, it was different back in our day, but when was your day? I said, because it's been like this for 20 years. It's not a full guarantee, it's a limited guarantee. And whilst not every bank does a limited guarantee, most of the majors will do a limited guarantee. And it's been this way for as long as I've been lending, which is over 20 years.
It's really interesting because I had no idea, right? And it's either all or nothing. You know, that's what I thought with guarantors. So then it goes back to education, right? And meeting the person, understanding what their situation is, and maybe giving them not a traditional kind of one-fit solution.
That's right.
Do you find that a lot of this happens? Like, are you finding yourself thinking outside the box depending on the person and their situation?
Absolutely. We had other clients that we were thinking about this. I mean, they approached me through hey, look, mum and dad is a guarantor. And we actually worked out that one of them was actually a professional in the medical industry, right? A pharmacist. Now, some banks have policies in that space where we can lend up to 90% of the property's value with no mortgage insurance. I mean, that's the whole key of a limited guarantee is to remove the mortgage insurance. If they have a little bit of a deposit, great. In this instance, they had enough deposit and enough funds to cover 10% plus cost, but we wanted to avoid having to pay lender's mortgage insurance.
LMI.
Now, if we don't know what LMI is a premium that the bank will charge anytime we lend more than 80% of the property's value. It doesn't cover the borrower at all. It covers the lender. Hence why it's called lender's mortgage insurance. However, the borrower pays. It's a one-off premium and it's on a sliding scale. So the higher over 80% we go and the larger the loan amount, the more you pay. Like I've seen LMI premiums to be $35,000, $40,000. And hence why I understand why people want to avoid that, because it's just another cost that they don't want to have to go through. And so one of the avenues for certain professionals is we can lend in mortgage insurance territory above 80%, up to 90, sometimes 95, depending, without having to pay mortgage insurance. And there is a list of certain professionals, pharmacists are one, accountants, solicitors, and then your medical professionals, of course, your doctors and so on and so forth, just to kind of paint a picture around what type of professionals we're talking about. But yes, there is an avenue.
Is this common knowledge among brokers? Or maybe it should be?
Right? Yeah, for sure. It should be among brokers, of course.
But I don't think it's common knowledge among the people, normal person like me.
No, it's not common knowledge amongst the people. And this is why individuals will approach a broker. And this is why statistically 5% of loans in Australia originated through a broker. Because when you approach a bank, they're only talking about their product. That's it. When you approach a broker has access to circa 60 different lenders on their panels. And we're not thinking about one bank, we're thinking about the individual and not only what policy is best for them, but what bank and product is best for them. And sometimes what policy is best doesn't necessarily translate to the best product. And so sometimes there has to be a bit of a way off, a bit of a trade-off, depending on that. Because if we need to go with a certain bank for policy because they've got the best policy to gain borrowing capacity, for example, they may not have the best product. But that's okay. That's a strategic decision we've made to go with that bank because we are going to gain. There's benefit from going with that bank. So my job as a broker is to look at your best interest. What is your best interest? And that doesn't necessarily mean the cheapest product. That could be a structure. It could be where can we get our best bang for buck, like in terms of loan amount, because not every bank assesses loans the same. Their methodologies are a little bit different and their policies are a bit different. And that's our job to kind of know where to go to get the most.
I mean, the analogy that came to my head is kind of like it's a puzzle and there's one particular piece and that's the person that's come to you with this, I want to borrow this or I want to do this. And then you've got to take that piece and shop it to all the different puzzles that are out there. So, I mean, and there could be, you know, one piece that kind of fits in this bit but then doesn't fit in another bit, and there's an element of like translation and knowing what everyone has to offer, and
there is a
like
bit.
doesn't that do your head in? Like
I mean, to the average person maybe that might do their head in, but I'm very analytical. I'm very that kind of minded, right? I'm an analytical person. I'm process driven. And because I'm analytical, I love seeing all the options and working through what's on the table. Who can we use? Yeah. What's going to be the best fit? And sometimes we need to be strategic with lenders, and we need to stage. You know, we need to stage our applications, and a different can of worms now. But depending on the client and what their needs and objectives are, or their goals in common terms are, we need to move each chess piece strategically. And sometimes it is, especially for those clients that have a larger portfolio, or are on that journey of building their portfolio. Like this might be property 1 for them, then it's property 2, and then where to from there? Right? Do we start thinking about investing in different structures, which the budget has thrown a spanner in that works as well? There are other avenues which then the broker and the accountant kind of get together, and the client, of course, and talk about what is the best strategy for you, from a growth perspective and a tax strategy, and what's it going to cost you in the end. And there's lots of different professionals that help with that.
So back to that situation where the limited guarantor, now I've got the terminology, back to that situation, what ended up happening? Did it happen where the parents helped them get over the hoop of the first couple of years? And then did they help the second child? Tell me about that.
Beautiful. In all cases, the parents have been on board. So once I've had a conversation with the guarantors, because part of my obligations, my responsible lending obligations, is to have a separate conversation with the guarantors. But of course, the applicants need to open that door. So they need to suggest that if this is something, and I send them a fact sheet just as a starter, as a conversation starter, and then let's have a chat. And then I break it down and I take it through in plain English. They've all helped, and they've all been glad to help. And the plan is, of course, in 2 or 3 years' time, once the property goes up, to release and go again. I have seen in the past, in my banking space, that yes, there's plenty of guarantors that have released off their kids' loans, either to help another child or for their own purposes. We want to release off because we want to sell this property now and we want to do something else, right? Heaps. And it's very easy to release. You know, the banks call it a partial discharge because they're not discharging all securities. It's a partial discharge. It's a form. They'll do a valuation on the remaining security. So long as that valuation stacks up, guarantors are free to go. It's as simple as that.
You say it like it's so simple.
It really is.
It's not. For someone like me that knows nothing about this space, it scares me, right? Like someone's peeking under the hood a little bit, like looking at all my, private things that, like, I'm talking about, my bank statements and all this, and like, how do you deal with that? Because I imagine when someone comes to you, like, they're scared of sharing particular information or...
That's a great question. On the guarantor's side, it's limited by what we ask. So we ask questions that are directly linked to their property. What's the value of your property? How long do you plan on keeping it for? Do you have a mortgage on it? And if so, what's the balance? Once we have that data, we work out, is there enough equity? Is this structure feasible? And once we've worked that out, then we go through the motions of explaining how it all works. But we don't ask them about anything else outside of the property, the guarantors. We don't need to. We don't need to ask them about their personal assets, their personal liabilities, what your income is, because they're not a servicing guarantor. They are an equity guarantor. And because they're not a servicing guarantor, i.e. they're not on the hook to help repay the loan, we don't need any of that data. So that helps mum and dad feel a bit more comfortable as well, because sometimes mum and dad, they don't want their kids to know, as strange as that is. And if we had to go there, it would be a separate conversation with mum and dad alone, without the kids present, because I'm obliged to have a separate conversation with mum and dad alone as well. So typically I do keep it separate anyway, but more often than not, we don't need to go there with that line of questioning, which makes them feel a bit more comfortable too. Makes it feel easy. If you make it feel easy, although there are some moving parts behind the scenes, and that's my job, but it's not that hard from the customer's point of view, and it shouldn't be. That's our job, is to make it look easy. People say, you make it look easy, you make it sound easy. That's my job, to make it sound easy. To take the stress and the headaches away from you. That's the whole job of a broker. Otherwise, you would do it yourself. You would apply online directly to bank, and then you would be the person doing everything But nowadays, people don't want to do that, and they shouldn't do that, because a broker can give them different options, what's probably better for them, because most people, they just approach their own bank. They don't know what else is out there, but our job is to provide options.
Yeah, I love it. I love it. I want to talk about the budget. Again, I know nothing about this space.
Yeah.
What do I need to know? As a small business owner, Tell me, what do I need to know?
Stay close to your accountant is my first bit of advice. Everyone is at the moment navigating around, what does this mean? What are the impacts? I mean, it was announced, a week ago. Budget night was a week ago, and there was some proposals in there, because at the moment it's just a proposal. It's not legislation yet. It's just a proposal, and everyone's jumping up and down. But I think you need to stay close to your accountant, stay close to your broker, because that will affect small business owners if some of the things that they said are coming do actually come through, especially those that are operating and trading through a trust. That's for small business owners. For individuals, negative gearing is probably the biggest impact. But stay close to what that means for you, because that might change people's decisions on whether they hold property or whether they offload the property. And if they have the capacity and capability to hold, then they may choose to do that. But maybe not everyone is in that boat, right, or has that luxury. And I wonder if the government's kind of put that in to force people down that road. Well, I can't afford to hold this property anymore. I'm going to sell it, and therefore create this stock on hand, if you'd like to call it. So then it gives perhaps owner-occupiers a chance to get in. I mean, if that's the government strategy, no one really knows.
No one really knows.
No one really knows, right? And I was talking to my accountant last week, and I said, well, tell me what you've learned. And they said, we're still navigating what this means and the full impact, and we won't truly know what the full impact is going to be until legislation's passed. That was just an announcement. Now they need to draft the legislation, and the legislation needs to be presented in Parliament, and the bill needs to be passed. But from what we do know, they're talking about cutting negative gearing, cutting capital gains tax, and starting to tax trust distributions. That's going to hurt a whole bunch of people from a tax perspective. But taxes will always change. They'll never stay the same. So whilst it might come in, it might also change in the years to come again. It's just a matter of, what's your individual strategy? What do you want to do? Can you hold? Do you want to hold? Where do you foresee property being in the future? And perhaps they might need to get some advice around that, or some modelling. A lot of buyers agents do modelling nowadays, and perhaps get some modelling done around where they think the property is going to be valued in 3 to 5 years' time. Can we weather the storm in the hopes that the tax reform might change again? I don't know. It's a really tricky one. It's a really tricky one, because it's still so fresh. People are still navigating around it.
And I think that's key, right? Like it's stay close to the people that are not are watching it closely.
Yes.
So that you can take their best advice.
Correct.
I think that's across everything,
Absolutely.
Yeah, and I think it's hard. It can be a bit overwhelming to stay ahead of everything. So you can't predict the future, but the modelling and all of that kind of gives you a good insight into what's potentially going to happen.
That's right. And the more modelling you do, you start to make an educated decision. If this property is not going to grow, then why am I holding it? They might say, well, if I hold this for another 3 years and there's no real capital growth over the next 3 years based on the modelling, then they may decide to, I'm going to relinquish this asset now, free up the cash flow now, and we'll go again later. But on the flip side of that coin, if there is a trajectory for that particular property to grow, then there may be the decision to hold. So I think modelling is going to I think there's going to be a lot more people doing that. And they should be doing that.
I want to ask, when clients come and see you, what are the 3 things that you wish that they knew? Or, if you could educate now in the masses, what are the 3 things that you would tell them about any kind of financial situation that they find them in?
One of the biggest things I see is no one wants to have a loan for 30 years. Yeah. And you don't have to. And a lot of people say, but how do you pay off your loan sooner? And there is a couple of small things that everyone can do to pay their loan off sooner, right? And I learned this many, many moons ago, right? And some banks, and I'll explain the methodology behind it, some banks do this and some banks don't. And this is another key difference between which lender we're selecting to go with based on your goals. So if your goal is to pay the loan off as soon as possible, one lender, whilst may have the cheapest interest rate, may not be able to offer you weekly or fortnightly payments. And I speak about weekly or fortnightly payments because the first thing anyone should always do is pay their loan either weekly or fortnightly. Try not to pay monthly if you can avoid it. If you have the opportunity to pay weekly or fortnightly, do that. Pay weekly or fortnightly. What that'll do is interest is calculated on a monthly basis. Interest is calculated daily but charged to you once a month. So if you increase the frequency of payments, the interest calculation over that month will be less if you're paying weekly or fortnightly versus monthly. Now, some banks will either calculate the true weekly or fortnightly payment, meaning they take the monthly payment and they divide by 4.33 or 2.16 to calculate the true weekly or fortnightly payment. But other banks simply divide by 4 or by 2. And I use this analogy with almost all of my clients, right? If you pay weekly, how many weeks in the year?
52.
Okay. How many fortnights in the year? Well, half of 50 is 26. 26.
Yep, that's right.
There's 26 fortnights in the year, yeah? And half of 26 is 13. But there isn't 13 months in the year. There's only 12. That's because some months have 5 weeks and other months have 4. So the banks that simply divide their payment by 2 and by 4, if you choose a lender like that and you make that frequency of payment, you'll end up making an extra full month's payment each and every year just by paying weekly or fortnightly. What does that mean? It means that you are shaving between 5 and 7 years off your loan term purely by paying weekly or fortnightly instead of monthly. So if your lender allows you to pay weekly or fortnightly, change. Do that change. Ring them up and say, I want to pay weekly moving forward. Then if you can focus on paying an extra full month's payment each and every year yourself, that gives you 2 extra payments each and every year. And those 2 extra payments will shave your loan off 10 to 14 years. So all of a sudden, you've taken a 30-year loan term and you've compacted that down to as little as 15 years, just by doing those 2 very small things. So that's one thing that I always say to all my clients. Understand the methodology and how interest is calculated and then compounded. Small things daily or weekly, daily is a bit much, small things weekly add up to a lot. That'll save you not only 10 to 15 years in your loan term, that'll save you hundreds and thousands of dollars of interest. And that'll in fact accelerate the reduction of that loan, which then opens up opportunities to perhaps use the equity to then buy something else. We're leading into a different topic now.
Yeah. Well, I was going to ask because that's tip number 1, right? If you can, pay it down quicker, right? So by inadvertently paying more frequently. Yeah.
Correct.
Yeah.
Correct.
Okay.
And a lot of people just say, easier said than done, Steve. You know, an extra full month's payment for me is $6,000 a year. I just don't have it. I'm not asking you to find it. Just pay weekly or fortnightly.
So you just take your total monthly, whatever's due, divide that by 4 or 5, whatever.
Divide that by 4.
And then
pay it weekly.
Pay direct
Pay
debit
weekly.
it, schedule it?
Yeah. Yep.
I could do
And
that.
sometimes the banks will do it for you.
Yeah, okay.
But ask the bank, because not every bank takes a divide by 4, divide by 2 approach. Some banks may calculate the true weekly payment, which is, their calculation is 4.33, the division, or 2.16. If the bank does it that way, then you need to consciously say, okay, do that, but I will also then put extra in. And that extra might only be $50 a week. Sure, let them do that for those banks that calculate a true weekly or fortnightly figure, but then consciously set up an auto credit into your home loan of the extra 50, whatever it is, right? You know, take the number, divide by 4, compare it to what the bank's telling you, whatever the difference is, make that as an extra payment.
Yeah.
That alone will give you 1 full month's payment each and every year.
Yeah, okay. So that's like tip number 1, right? So what are the other 2 tips that you give?
Tip number 2 would be, obviously, make an extra payment on top of that. So tip number 1 is weekly or fortnightly. Yeah. Tip number 2, focus on making 1 whole extra payment on top of that. Yep.
Like a year? Or like...
year, okay. Yeah. So if your payment's $5,000 a month, your goal is to pay $5,000 extra in that year. Okay. Again, break it down.
Yeah.
Break it down. Don't save $5,000 and then pump it in. Break it down. What does $5,000 mean? It's $100 a week. You say add $100 a week. if that's what the repayment is, and make that your regular into your home loan, and that'll shave 10 to 14 years off your loan. Yeah.
Wow.
Tip number 3 is review your loans periodically. Now, your broker should do this for you. Yeah. I mean, I do annual reviews for my clients without them asking. Yeah. On their anniversary, hey Debbie, just had a quick look at your loan. Still seems really competitive with what's out there in the market at the moment. I'll review it again in 6 months' time. Got any issues, give me a call. But stay in tune with what's out there in the market, because what banks do, the majors and all lenders, what they do is they sharpen their rates based on what market share they're looking to bring in. So if they want more market share, they want to bring in clients, they will be very aggressive in their offers. Yeah, so their rates will be really sharp, and it won't always be the same. They chop and change. But an individual can't keep up to speed with what the banks are doing all the time. But us as brokers, we see it every day, because we're shopping different deals with banks every day. So we see it. We know who's got the best offers at the moment. We know who's got wiggle room and who doesn't. And this is why your broker is your friend. And your broker will and should be doing annual reviews for you at the very least.
I say though, that it's not normal for a broker to check in every year, because like I went through a broker to get my first home loan. I haven't heard from him in 10 years. Like, it's not normal, right?
I think the normal is changing though.
Okay.
Yeah. It is very much becoming a service-based business, and it always has been a service-based business, but more so now. Let's lead back to when we first started the conversation. You need to be very professional with your clients, and I'm not that person. I am not that person. I'm a very easygoing person. I want to get to know you on a personal level, you know, how are the kids, what's going on, what's happening in your personal life, all that sorts of stuff. On that same token, I care about you as a person and as an individual. So for me, it's not transactional. That's not the broker I am. I'm not transactional. I'm here to build relationships for the long term. Maybe even be invited to your family barbecues. Who knows? But that's the type of broker that I am. And your broker should be giving you at least annual reviews, or at least a check-in to say, g'day, how are things going? Is everything okay with the loan? Do you need anything from me? Is there any questions? A quick phone call or a quick email or a text message, whatever it is, some form of contact I think is critical. And I would be very surprised if brokers are not doing that today.
Okay.
Something to think about.
Something to think about. So that comes to the end of our episode. I think I've learned a lot from this conversation.
Okay, good.
I know what Resi stands for.
We should do it again. What are we going to talk about in episode 2?
Don't know. Budget.
The budget. Yes, the budget.
The budget, again, when it comes into legislation.
When it comes into legislation.
Yeah. Is there any piece of advice that you want to leave as we wrap up this episode? Have I put you on the spot?
Yes. Yeah,
sorry, not sorry.
Yes, piece of advice. I mean, I think we've touched on a lot. We've touched on a lot. And I think the biggest key is stay close. Stay close to the professionals that you lean on, that you rely on. You know, that's going to help you. That's going to help you on your journey. Because it really is, yeah? It really is. As financial professionals, we are there to help you on your journey. Yeah, I am. I really want to see you succeed. I really do. And I want to show you and give you tips around how you can get there sooner. That's just what I want to do. So stay close to the people, especially in these times. I mean, there's talks of another 2 interest rate rises. Another 2 interest rate rises, we'll start to see the tipping point of Aussies. We are going through tough times at the moment. Interest rates are as high as they've been since the GFC, except our debt level has pretty much doubled. You know, I went through the GFC and I was on a fixed rate at 7.5%. But my lending was, $500,000. Most people's lending is more than double that today on the same kind of rates. That hurts. Stay close to the professionals and just keep your eyes and ears open around opportunities where you can potentially save some money.
Amazing. It's lovely to have you on.
Thank you.
Selfishly, I've learnt a lot.
Thanks for having me on.
Yeah, but for anyone that wants to get in touch with you, where do they find you?
They can find me either by calling me direct on my phone, and where do they find that? So jump on my website, my contact number's there. There's links to all of my socials on my website. There's also a contact form. That's probably the easiest way. Straight into my website, inlendsolutions.com.au. You'll find all the contact details you need to get in touch with me from there.
Amazing. Great to have you on.
Thanks for having me. It's been a pleasure.
Cool. Great. Done.